This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Let's call this my emerging trend-following trader episode. Two traders today, Michael Melissinos, Melissinos Trading in the New York area, and Glenn Graham, Golden Point Capital in the Chicago area. Two relatively new trend-following traders, two relatively young guys. Both of them started their firms in their 20s. Both roughly have a 4 to 5 year track record in that range. Great insights on starting out. I hope you enjoy both of these conversations with Michael Melissinos and Glenn Graham. Yeah, when you said WeWork location, you must have assumed that I know what that is. I have no earthly idea what that is.
Oh, it's a startup that offers shared space to other startups, other solopreneurs, and just people that are working out of their home that want to get out of the house. So in New York, they have tons of locations, and they're all over. They have some in California, they have some in Chicago, and I believe they have some overseas too.
Well, it's an interesting point to bring up because for the life of me, and I've wasted a lot of money on office space. Not for over a decade. This was when I first started out, but it was amazing that the numbers of people out there that somehow or another judge you as being credible because you have an office.
Yeah, it's just one of those
a physical office that they can come to and see you and touch you, and then somehow or another your intellectual capital means nothing. But if they see the office, then you're real.
I have one time when I believe I was early in college, I was delivering pizzas in the summer. A guy who walked, who was friends with the owner, was a big shot at, I don't know if you ever heard of the firm TradeWorks. They're a high-frequency firm in Jersey. This guy, they're all MIT guys, bright dudes. This one guy I became friends with. We have lunch every so now and again. He started his fund with these other guys right after September 11th. He said for a while, it was tough to get allocations, tough to get people taking them seriously. And these are guys that had, I think, 15 or so years on the street, and like I said, MIT backgrounds before they ever started their private fund here. He said it wasn't until we got an office until we started to get taken seriously. I mean, I was like, okay, I don't know, man. It's
I went out. This was probably many years after, and so I still remember seeing Bill Dunn's office for the first time in 1996, and just blown away at how down to earth it was. It was kind of like a law office or a CPA's office. But before he moved his shop to Stuart, Florida, he was in a section of Fairfax County, Virginia called Mantua. And on an old MAR from the 1970s, I found the address, and it was just a split level house. And I went and actually took a picture of it because it was literally like 5 miles from where I grew up, just to see where he had started Dunn Capital. And it was just a standard issue, split level 1960s house, nothing spectacular or anything. But I just wanted to see it because it was like you want to see that in your mind and say, okay, what's important and what's not important.
Yeah, it's like seeing, the Jobs and Wozniak garage. When they started Apple. Same idea. Doesn't mean anything. It's just good for TV and the people that are much later to the game, much later to the trend. They want to see all the bells and whistles and all the cool, fancy stuff. And
Okay, let me jump into the critical stuff here. So I'm looking at a track record. You're on your 4th year. You clearly started this track record in your 20s, right?
26.
Okay.
Yep.
So, and before that, 2007, 2009, you were at Bear Stearns. You're at J.P. Morgan. Were you at Bear when it blew up?
Oh yeah, I was there.
Was this your first Wall Street? Was this your first Wall Street job?
First Wall Street job. Yep.
And so you've already read the book Memos from the Chairman, which is a great book, right? His memos from Ace Greenberg. That was a fantastic book.
Yep. Yeah, he was. My team at Bear, I was on a market intelligence team. So that was basically another set of eyes and ears on for the traders, and we were basically a liaison between the traders and the research department. So if any critical news hit the tape, what it meant for which stocks, how it was going to affect earnings, and I covered healthcare, so there was a lot of drug announcements, all this stuff. So I had to, basically follow all those events and all those things.
How long were you there before the summer of 2008?
I started in October 2007, so I was there 6 months when Bear went down. So October to March, 6 months. Yeah. So that was fun.
I mean, that must have been wild though, because you're only there a short period of time, but clearly you're walking around and you're meeting people and people maybe sitting right next to you that are worth 10, 20, 30, 40, $50 million. You're talking about people. There's a lot of wealth in that building at that moment in time, isn't there?
There is. And I'll tell you a story that helped me. All right. Rewind for a sec. Prior to Bear, I worked at a public accounting firm where I was auditing hedge funds, so going down the CPA route. I couldn't stand it after a while because, I came from a sports background. Sports background, you want to be in the game, so to speak. I don't want to be on the sidelines keeping score and checking the facts and keeping the books. I want to be in the game. So it was, before Bear at this job when I read your book, the trend following book, and that's what started me to, basically, started making me smarter as to how to trade, how to invest, and how to think about things differently. But still, I was in this, but I want to go to Wall Street so bad. I just want to get out of here. I want to get out of this accounting job. And then I ran to Bear, basically with my hair caught on fire and not really thinking it through, because I would never go back today to Wall Street. But yeah, so while I was at Bear, and I believe it was the day or two after it went down, I was standing in front of, the thousands of screens they have there on the desk. And the senior healthcare trader said to me, Mike, I want to tell you a story. So my daughter is in grammar school. I forget how old she was. She says, a girl in her class a couple days ago killed herself because she was getting bullied, and we have to go to the wake or the funeral tonight. I forget what. And he said, and he pointed and motioned with his hand towards the screens and towards all the people that were, upset or neurotic or running around. He said, all this means nothing. It's just money. This means nothing. And that was, and I was like, yeah, like a guy you said, is probably worth, a ton of money that lost a ton because he had all the stock there. That was the second big wake-up call to me as far as being a human. Nothing to do with trading or anything. But basically getting focused on, okay, what do I want here? What do I want out of this life type of deal? If this is a guy who I thought, 6-7 months ago was like a guy I wanted to be like, because I didn't know any better. I just wanted to be a rich dude. And then now he gets humbled by his company going down. He was there, 20, 30 years. And then he gets humbled by a girl in his daughter's class killing herself, for God's sake. She's probably 9, 10 years old. And hearing that as a 23-year-old at the time, that woke me up. Also, Bear going down woke me up too. And also your book before that woke me up. That's when I started to track a lot of these guys that
let me take a step back. So is there any, so you're at a Wall Street job, nothing to do with trend following for a couple of years. You got an accounting background. What would now you've got a 4-year track record as a trend following trader, and we're going to talk about your process and your system and your philosophy, your psychology, and all the nuts and bolts.
Yep.
But what was the trigger? When was was there a specific trigger where you woke up and you said, I don't know what you're going to say, so I'm curious myself. Was there a specific trigger where you said, okay, trend following, I'm going to go this direction, and then once you decided to go that direction, what filled in the blanks for you?
Okay, well, I had, going through the '08 crisis and then getting laid off at J.P. Morgan in early '09. So the crisis is when I started to track all these guys, the legendary trend guys. And
so October of '08 was your big wake-up call. You said, okay, wow.
Yeah, because it was putting the philosophy, the common sense, because trend following to me is just common sense. And then seeing in real time the market volatility and then the performance was like, okay. Because like I said before, I was from a sports background, so I was only concerned about winning. How do I win the game? The crisis woke me up because I saw the numbers in real time, not looking at like, oh, what'd you do in 1980? Because I can't, you can't feel it back then. You can see, oh yeah, they're good, but now I'm in it. I can see what's going on. I feel it. I understand now how it works. So that woke me up, and then, I wimped out for a while. I didn't make the move in '09 after I got laid off. I made the move in 2011. In between there, I was actually teaching some kid who I met at a trading job I took afterwards because I just wanted to be in trading somehow, and I couldn't get a job on Wall Street anymore during the crisis. So I was teaching this kid about trend following and trying to build systems with him, and that helped me learn. And then, of course, we go through the late 2010 hot streak, and I said, Jesus Christ, I missed another one. I missed another hot streak. All right, enough.
But were you building and testing systems on your lonesome at this time?
Yeah, I was.
Okay, who was influencing you, and what was the mentoring? Was there any? Or was it just you on an island?
Me on an island, and I called some guys. I called David Drews, called Ed Dakota. I called a bunch of guys. They talked to me.
Did you get through to Ed on the first shot?
No, not on the first shot.
A little dedication required.
Yeah, but he's a real nice guy though, man. He'll open up to you if you show you're willing. He's like got that Yoda part about him. If he senses you're not willing, click. He's just not gonna pick up. But David Drews is great, and they just kind of helped me through the ABCs.
What did you have to tell them for them to think that you're serious? Look, I mean, I'm partly responsible for elevating their names to even higher levels. I'm not taking credit for anything they do, but I mean, sometimes they must get mad and say, oh my God, Covel has sent all these people emailing us and calling us and all this shit. And so I'm curious, was there what did you have to say to them for them to know that you were above board, serious, you're legitimate, that you're going down the path, you're actually going to do this? What do you think it was you said?
I think I told them the story about how frustrated and how pissed off I was about missing the opportunities in '08 and opportunities in 2010. I'm starting a fund with or without your help. I'd really like your help, but if you don't want to help me, I understand. I understand you're busy. I understand you got better things to do than to respond to it. 25-year-old.
Were these initially voicemails you were leaving?
No, I left emails, and then they got back to me and said, "Call me at this number." Bang, done.
Now, and was Ed and David the only two that you really consulted with?
Yeah, I also talked to a guy in New Zealand, Mark Sleeman, who runs. I think basically he's got his own money, but he also has some other money. He's I think the name of his firm is MS Capital Management. He's a good guy. That was an expensive phone call. Same with Drews because he's in Hawaii. Yeah, we talked, 20, 30 minutes. And I'm like, I've hit the jackpot here because I still felt kind of dumb about this stuff.
What was the biggest thing that David said to you when you call him up and you start having this conversation? Was there an aha moment in your conversations with him where he triggered you a little bit farther down the path? I know there was, but what was it that he started to trigger you on?
Well, I'm more concerned about the product and performing well more than the raising of the money. That just comes more natural to me. Being an ex-baseball player, I just want to play well. So what he said, look, Mike, look, there's three things that contribute to performance. The number one thing is your portfolio construction, what you trade. If you don't trade a market that trends well, you can't make money. Second thing is your risk management, how aggressively you bet, how you scale in, scale out, whatever. And then way far down the list is when you're getting in, when you're getting out.
Had you seen that bet sizing article that David and Ed had wrote together before you had the conversation?
Oh, yeah.
Okay.
I read everything.
Okay.
I read your book like 3 times. Funny story about your book. When I was reading it during the off months in the public accounting firm, I was 23, and I'm not going to lie to you, I slammed the book shut. I said, this guy is out of his mind. No way is it this easy. Because to me, trend following came pretty natural to me as far as thinking goes.
Did I say it was easy?
No. I would just look at these guys and just reading through the philosophy of it. I'm like, all right, what is the catch here? Because I was dumb at the time. And I still may be dumb, I don't know. But I slammed it shut because I didn't know any better. And I thought, it sounds too good. It sounds too easy. I don't know what it is. And I didn't follow through with it initially. I went to Bear Stearns and closed the book for a while. And then, of course, right, then it was probably during a drawdown phase, right? The trend followers weren't doing well at that time or something. If they were, I probably would have kept reading. But, slammed the book shut, and I just thought, I just don't trust it yet.
It's funny you say that. I saw some when it first came out. I think a lot of it, frankly, even the criticisms, if people look at like Amazon reviews and stuff, a lot of it was really business competitors. Because I think for those people, it took me a long time to realize, because there was such a vociferous reaction when it came out from a minority, and a minority on the internet can look like it's a majority. And so I didn't realize initially how influential or how many people the book was reaching in a positive way, because sometimes the negative voices, and even I remember there's a guy for Financial Times that wrote this negative review, and I look back on it now and I'm like, and I'm working on something right now, and I'm going through all these old documents of David Harding's going back to the late 90s, and David Harding is one of the most blunt, in your face guys about trend following. I mean, it's a little more smoothed over now that he's, at these massive AUM levels. But man, that guy is so on fire and so on target and so in your face about trend following. And I look back on it now and I'm like, who are all these morons that were saying trend following was crazy? I just, that's the only, I mean, I'm not saying like I'm the smartest guy on the planet either, but I'm just like, it is as you're saying, it is, once you see it, and the light bulb either goes off or you go back and you take the blue pill or the red pill, which I can't remember when it was, and you fall asleep.
Yep. And I would love to hear, I know you probably have some private audio with, I think you said the other day, Larry Haight, and then also, as you just mentioned, Harding. Cause I love to hear that blunt, behind the scenes stuff. I appreciate the toned down versions, when they go in the public eye, but you just love to see like, goddamn, you're worth, how much you do this so well. You're a successful dude. I want to hear you talk how you talk. I don't want to hear your marketing type pitch or your political spin or whatever this. That's what I loved about when I talked to Dave, Drews, and Ed. Forget it. Ed will just tell it like it is, no matter what day it is and who he's in front of. But, I love that because I grew up with a dad who, was like that. So I appreciate that. That's probably what I appreciate about trend following in general, is that here it is.
Yeah.
You either there's no secrets, and it's really up to your discipline and your, I don't know, mental, fortitude and basically having your shit together in order to do this well. And that's what I love so much about it, that I've come to love about it. Initially it annoyed me because I just didn't know enough, and I thought it was just.
I will add as we talk about color, and I say this in the most respectful of ways because they're two legendary traders that have done everything for a long, long time. But there's no doubt in all of my interactions, I'm trying to think of anyone that tops. And I've never met them together. I've always met them at different times and places. But Larry Hite and David Harding, easily for me, the most color off the record. But in terms of obviously their business, I mean, they are on target, brilliant strategists, brilliant traders, and describe what they do fantastically in a blunt fashion, which I love. I mean, they're both the economy of words that those two guys use in particular, and clearly Ed Secoda's like that as well. But Larry and David Harding, both very efficient and really make you think. So it's good stuff. Good stuff for sure. Find trends, align with trends, and manage risk. I like how you've done some of your presentation. Very straightforward. That reminds me a little bit of Ed. Find trends, align with trends, manage risk. Okay, for the uninitiated out there that might be listening right now, and look, I don't know the exact percentages of my audience and where they're coming from and who knows what, but why don't you talk about that? Finding trends, aligning with trends, and managing risks. 3 big stump lines. Why don't you explain each of those briefly from your perspective?
Well, the people who I market to and who invest with me are people, by and large, who have no idea what trend following is. They couldn't name one competitor of mine. So before me, they had no idea. So when I talk or I explain or give presentations to people, I try to be as simple and as straightforward as possible, because educating people using the lingos that's a little above their level, forget it. They'll never do it. Yeah, I mean, I like to draw a lot of analogies to things to make the.
Where are you meeting clients today? Because I was thinking about this. Here you are, a young guy, small assets under management comparatively to 30 billion as a high-end trend following trader. So the motivation to start today when you see all these big funds out there, but when you tell me that, you say, hey, I'm finding people that don't even know about trend following. And that's something I would disagree with some of the larger fund managers. Some of the larger fund managers would say, well, everyone that needs to know about this knows now. And after October of 2008, they all know, et cetera, et cetera. Perhaps at the high level of institutional allocations, they do. But I think for the vast majority of regular people, and these could be successful doctors, attorneys, et cetera, absolutely no one has knowledge of trend following.
And so I was coaching a travel baseball team in Manhattan for a year or two. You can imagine the families of these kids, they're very wealthy. We're talking heads of departments at Wall Street firms, heads of hedge funds. And so I met a guy who played at Georgetown baseball. So we had that in common because I played at Seton Hall. So we both played in the Big East. This guy was a huge dude at Viking Global. Viking Global is a Tiger Cub fund, $30+ billion fund, long short equity hedge fund. I talked to him. I said, look, this is what I'm trying to do. I imagine, $3 million. I started with 300,000. All I'm trying to do is manage money for good people and just do my job well. I went to his office, talked for, 30 minutes, an hour. He had no idea what trend following is. He's like, the only thing I know about trend following is Man Group. That's all I know. So this is a guy who's probably worth hundreds of millions of dollars and is a huge dude.
And the question should be reversed as to what the hell is a long short hedge fund these days, because
stock picking fund that's better. Probably,
yeah,
right?
well,
that's
and a lot of them, if you look at their equity curves, they look like the S&P and usually less than the S&P.
Yeah. That's another conversation on how and why people continue to pour money into those, I would say, sub-optimal performing products. But the beauty of marketing and persuasion and all those fancy things.
Get back to how are you go back to I kind of interrupt you there. Where are you finding the complete novice to trend following investors? How do you go about locating them?
I go through my contacts list and ask for referrals, and that was one main reason why I went to WeWork, because I feel my mission is to perform well, number one, but also perform well for people that value the same things as me. And I feel that those people exist in the startup culture for me, because I think they seem to be more on my level. If we hung out, I'd have a better time hanging out with a person from a startup than a person at a pension fund. I just feel like I wouldn't get along too well or as well with a guy at a pension fund or something versus, a tech startup that's just looking to protect.
You're not the only person that has that problem.
Yeah, well, we all have our things, fine. But, so that's why I went to WeWork, because they're all there. That's who's there. The startup guys, and I feel like I can talk to them, and they'll listen, and they'll ask questions, and they care about their money, and they care about doing well, because they don't trust Wall Street anymore. Forget it. They're not giving their money to an advisor anymore. It's over. I
want to circle back to the find trends, alignment trends, and manage risk.
Yep.
Those new traders that you're talking to, and you start talking about what to trade. You're one guy, you probably have worked with some contractors on various parts of your business. How do you explain to the rookie, to the novice, even if they're a successful person, that you have the skill to trade coffee, corn, cotton, orange juice, 5-year notes, British pound, Brent crude oil, gold and silver, the Hang Seng, lean hogs? The floor is yours. How do you explain that you have that skill? Because you clearly don't have the fundamental skill to do it.
Just like a baseball analogy, if I'm a hitter, I can hit a curveball. Doesn't matter who the pitcher is. It's the same pitch. So I can hit a fastball the same way. It's the same. What's behind it? A human is doing it, is delivering the pitch, or in this case, delivering the market. It's kind of the same pattern, right? Coffee is the kind of the same pattern over time, or I say it exhibits similar patterns than the 5-year notes than does the. You
mean the price chart? The price chart ultimately ends up looking the same.
Yeah, looking the same. Not different cadences,
acting the same, because there's human behind them.
There's human behind it, but it's delivering the same patterns at different times, different all these different things, different levels, different prices, but more or less, it's a similar pattern that I can hit, that I can trade. A curveball is a curveball, kind of no matter what hand delivers it from. Same thing with a fastball. It's a similar pitch, maybe a little different. One guy has a little run, right to left or sink on it, but more or less it's the same. So you don't see the best baseball hitters, getting taken out of the lineup because they can't hit this pitcher that well. Like, no, they play every day.
Okay, but a pitcher is a generally similar type thing, and he's got a ball. But what is similar to coffee and copper? What is similar to sugar and crude oil, to the euro and wheat? Define that similarity for the audience. I'm really forcing you to break this down. Maybe we're going to stumble into something here. I know what makes these things common, but sometimes I've got my own biases. Maybe I don't even explain it well anymore. I don't know, but here you are, you're a guy, you're one guy, and you're successfully trading this assortment of 36 global markets. 36 global markets. How the hell do you do that? Because you don't know what the coffee yield is going to be for next year. You're not attempting to predict that. And even if you could, what would the information be useful for? Dive into this subject. How can you trade 36 global markets?
Well, it's going down to the biological level. What is coffee? What is it? It's just a product that people make and consume and buy and sell. And in the markets, they're speculating on its price. It's just people reacting, predicting what the price is going to do. So, and they're all just yelling. If you break it down, like draw a picture, it's like the floor. They're just all betting on where it's going to go. It has nothing to do with coffee. It has nothing to do with the bean. It has nothing to do with where and how it grows. It just has nothing to do with that. It has with how people react and respond to it. And they're really reacting and responding to each other. So after a while, the price just becomes of what the people decide. It's just what people decide. It's not. There's no law that coffee has to be this. If the yield is, has to be this price, if the yield is this. There's no law. I think David Hardy said it a million times. The markets don't abide by physical laws. They abide by human laws, psychological laws. That's what makes all the markets the same. Because it's only people that are trading these things. There are no laws behind it.
If you all of a sudden transported yourself tonight, and you're off to a desert island, and all you had were the quotes, you didn't even know the names of these markets anymore, just the quotes. You could still trade these 36 global markets.
It'd probably be better traders if people numbered them, and they changed the numbers every day so they couldn't figure out which one is which.
You don't need to know which one is which to trade them.
Nah. And I think Ed said one time, he's like, I try to get dumber every day. Try to get dumber at trading every day. Just, you don't need to know all these things. You just need to know a few things. And be consistent at your discipline, whatever that is.
But we're in a society that's based on information overload. The more information that you can supposedly balance in this global game of Trivial Pursuit, that supposedly means you're brighter, smarter, etc. And supposedly that translates to higher earning, higher income, higher wealth, etc. The better you could play Trivial Pursuit.
Yeah, well, I think sorry if I bring it back to another baseball analogy, but if a scout or a high-level executive was thinking about drafting some player, he said, "Well, what makes you think you could hit in the major leagues? You could hit college. You could hit, yeah, sure. What makes you think you could hit this level? You don't have the experience. You don't have the knowledge to pick up on tipping pitches and reading cues on the pitcher's tendencies and all these things to get an edge, to get a leg up on the other player. So what makes you think you can hit?" It's like, well, I can hit at this level. I used to, once upon a time, I couldn't hit at this level. I figured it out. So I'm pretty confident I can figure out this level too. At some point, initially someone has to take a leap of faith on you, but they're likely going to extrapolate what you did in the past at lower levels to the new higher level now. I'd say that's the same people too. Like I didn't have this information day one, but I did it pretty well. I learned from guys that were doing it well before me, so I didn't need to reinvent the wheel or anything. But this is, I think people just have a worldview that trading or things that they don't know that well are very complex and difficult. I don't really believe that.
Your system is not set in stone, but it wouldn't be a system if you were changing the system every day. So comparing, you're going from college, let's say high school, college, pro baseball, you're having to prove yourself at each level. The moment you start your track record as a trend following trader, you really have to be as good as you are at the end of 5 years, 10 years. I mean, you can't just sneak your way in and kind of get your training wheels under you. You have to have it. I mean, when you first brought these clients in, what were you showing them before you had a track record?
Back tests and really just explaining the philosophy behind it. Trying to convey that, look, this is just like dieting. everyone kind of knows what to do, right? We know we should eat this way. We know we should work out this way and get our proper sleep and not drink and do drugs and all this stuff. If we want to be healthy, and that's the goal. So with trading, like, these are the principles we just need to follow in order to do it well. Like, and it's not, I don't make up these rules. This just seems to be the rules of how to win.
But hold on, but let me don't take away your credit too much when you say you don't make them up. But you have spent a lot of time testing. You have spent a lot of time making sure that these rules make sense and the back tests look legitimate. And there's a lot of different statistical techniques that you're doing to make sure of that. And so there's a lot of homework behind this. But I think the point you're trying to make is that it's not magic. But there's rules that you're using applied in a religiously disciplined way that ultimately, starting your fourth year, starts to deliver something that looks like a pretty good track record.
I gladly, and one thing I do that maybe the higher, bigger funds don't do is I show people my rules. No, my prospective investors. I said, this is what I'm doing, and I don't worry about giving you or showing you the rules, because what makes me do it better than you is that all these qualitative, all these intangibles, these discipline, and I'm just more into it than you. You're providing
a service for a fee. It's really simple.
Really simple. Yeah, my job is to perform well, is to do my job, and and I also show people how much money I have in the fund. So relative net worth. The investment, relative to net worth, no one's higher than me, because, and it should be that way, I feel. But, those things, I think, go longer ways in the end than showing people your fancy formulas. Formulas people don't, I don't know, at least the people that I'm marketing to, that I'm dealing with, don't care as much about that. They want the broad strokes, but they want, are you my guy or not? I think that's the chance for the young guy in the game.
Okay, so but at the end of 2011, you're up about 10%. You lose 12% in 2012. What were all those first-time clients saying when they see that 12% decrease?
Oh yeah. Well, a lot of them stayed quiet, but my dad was very vocal. He was like, I think you got to change this thing. You don't know what you're doing.
Change it to what did he want you to change it to?
Oh, he just wanted me to buy low, sell high, and do all these things that were just totally wrong.
Isn't this a little isn't this a little dangerous? It's one thing to have outsiders that I guess would have to find you to kill you, but you actually are getting your father invested, and he's not completely sure about what the technique is, but he's trusting you. I give you I give you credit for that maneuver.
I have a lot of practice at this. Another good story. So, like I said a million times, I played baseball. So during high school, I went to a really good high school for baseball in Jersey. And every year, freshman through junior year, I didn't start pitching the first game of the season. And he was livid. He was like, we are transferred out of here. We're going to this other school now. F these guys. They don't know what they're doing. You want to leave? I'll take you out. I'm like, relax. No, we're going to stay the course. I may not be the best guy day one here, but I know what to do in order to get there, and we'll get there. Okay? You need to relax. Of course, what happened? Freshman year, at the end of the year I was starting, and then sophomore, same thing. And then junior year, I ended up being, I don't want to, I don't like to promote myself, but, I was the best player on the team, all state, all this, all that. I said, look, and I remember going to him after I signed with Seton Hall. I was the first guy to sign a college contract, whatever it's called, going into senior year. And I said, you see, you just have to be patient, and we just have to do the reps. You just have to do the work. It'll work out. Okay? And I was basically having the same exact argument during this, the first couple years, years that were losing, those years were pretty bad. 2011 to 2013 were brutal, for trend following. So of course it was great practice to practice discipline. It was great practice to practice, client relations and learn how to handle drawdowns, for myself and for other people too that had no idea what this was, because they got into it like, Mike, you told us this is like trend following was better, and now the S&P is going straight up and this thing's going down. What's going on? And so that really demands, I think, your best as far as getting your mind clear on what you're doing, how you're trading, and then also how you're communicating what you're doing to them, to the investors. So
I'm looking at right now, spread across my desk, like 20 odd pages from your client presentation. And I was thinking, well, before I started this conversation, I didn't know exactly where we were going to go, but it's a really nice presentation. I'm going to give the pitch now. I don't know how you interact with clients, what your rules are. Obviously, there's regulation involved. But I think that for those people, instead of me attempting to go through, because I'm looking at the clock and I've already kept you for nearly 45 minutes, and as opposed to going through each of these, I think it'd be much better for those people that really want to connect with you and reach out and see this presentation, because it is a great learning aid as well. And for those people that look like serious clients, I'm going to let them just reach out to you. It's a really nice presentation. It's very detailed. I think people can actually learn a lot, and I think it would really help for those. This isn't a pitch. I don't know anything about your fund other than what I'm looking at the track record right now. But I think it's an interesting presentation. It's very good, and it's very straightforward. It's just very straightforward, and people should reach out to you, I think.
I love straightforward. I love clear, concise language that, and it's weird if I have a thing where if I don't speak clearly or don't let it all out, let all the emotion out, and I learned that from Ed and Tribe, because I went to Tribe before I started the fund. That kind of helped me push through the fear type thing to start it. And it's weird if I don't let it all out, and be totally transparent, I can't even sleep. I can't sleep at night, and I'll probably get sick. It's really strange. So it affects my health that if I'm not giving you all the information, I don't feel right. I don't know what that is, but I have that thing. I don't know what that's called.
We're going to end it on that one, Michael. I like that one. Hey, where can people go to find out about you, your firm, your fund? Where can they go? Where can we send them?
You can check my website out. The firm's website is melissinostrating.com. Melissinos is Melissinos. It's Greek. It's tough, but that's the name. I'm sorry, it's so long. But yeah, Melissinosstrating.com. I have some things on there that I think could give you some insight to who I am and how I do things and what I value and how we work. And if you'd like to reach out to me, my email's on there.
Michael, listen, it was good chatting. We'll have to do this again, and next time we'll get even more detailed into the aspect of trend following. But I think it was just an interesting conversation today. I think we covered a lot of territory, and I think people will enjoy it.
Yeah, I hope I motivate the next generation of young kids to start. It's not easy today.
Michael, take care. It was good talking.
You too. Thanks, Mike.
Now for my second conversation with Glenn Graham. You're basically in your fourth year of trading, but you're approaching, what if I'm looking at the month by month, even though you're into your fourth year, you're not yet the 3 full years of monthly data yet. But here's the interesting thing from my perspective. So the first year, which looks like half a year, you were down 9% approximately. The second year, 2013, you were down another 5% approximately.
Yep.
So there you are, you're about 18 months into trading and you're down, 15%. You're not feeling too good.
Right. Well, I'm sticking to the plan. My confidence is as high as it was when I started. And, the plan was the only thing that I have going on at that point. All I have is my simulated results and my faith and my confidence and ability to stick with that system.
Was there any element at that point in time, at the end of 2013, was there any element where you're kind of like, ugh? Or had you really, and we're going to talk about this, or had you really, you were at the point knowing the numbers and that this is how it could unfold to start?
Yes. I and all the historical testing I had done and all the research I had done in developing my systematic approach here. Yeah, I had seen that could happen. Certainly could. It's just the luck of the draw and where we start there, and it's just the ability to stick with it and full faith in that system is what kept me going through the times. And the same applies vice versa. I'm sure we'll fast forward to 2014 here in a little bit, but the same kind of discipline applies in good and bad times for following my system, following my plan.
So let me jump to 2014 though, because things quickly changed. I'm not going to say quickly. Let's just roll through the full 2014. And you end up 117% on the year. That is a big number.
Yes. That year, kind of 2014, we really saw lots of things come together. A question that we often get asked is, what changed? What changed from the
I'm not asking you.
months?
I'm not asking you what changed. I don't care what those. I'm just saying that's a big number. I know nothing changed. It's just the way the markets go. But now talk about in terms of like just what was your feeling at the end of 2014 though, seeing that number? That's a pretty substantial number. And I want to talk about also the idea that you are obviously, with that type of a number, are not at this moment in time in your life attempting to appeal to conservative pension funds that want to target 15% a year.
Absolutely correct on that level. I am certainly not in the realm of targeting that kind of money at this point. And that is a lot of the reason we've been able to target those kind of returns, because our investors know what they're getting into. We make sure to sell them very early on the level of volatility that can be associated with a strategy like ours.
Mm-hmm. Now we're now obviously what I only see you through January of 2015, but you were up 24% in January. So we're talking about a 13-month run that was just really rock and roll.
Yeah, it sure was. It was a lot came together, and really it was market conditions. In fact, that we were poised and our system was ready to capture those kind of long-term price movements, and we saw quite a few different themes throughout the year, throughout 2014. I'm sure you're familiar with some of the bigger ones. Now we were able to capture some of the different ones based on our flexibility and our risk metrics. We were able to trade and capture some things such as oats price trends, orange juice moves, things like that, live cattle, livestock. That was kind of the theme at the beginning of the year. Throughout the year, it was the grains trend, and then the big ones were at the end of the year, the dollar index, the U.S. dollar against foreign currencies, as well as energy trends. As I'm sure you're aware, we were positioned and able to capture all of the above.
Now, you mentioned the niche markets. Talk about your thought process on niche markets at this point in your career.
My belief with these niche markets is that these markets are really where the true hedging interest lies. And I believe that a true hedging interest can help drive longer term sustained price trends. And in these markets, there's a true need for, an orange producer or a timber company. They really need to hedge. And so they really are moving these markets in any given direction based on their needs. Unlike things that were manipulated by the government throughout 2012, 2013, almost on a monthly basis, these things were getting pushed around with no clear direction. I find that the niche markets, since they have that element of a true hedge interest, really tend to trend more predictably than some of the other markets.
Let me jump into, we're talking about some of your current performance on the firm today. I want to go back in time though a little bit. I want to know something in terms of you and early on. So how old are you right now?
29.
29. So young guy, putting a fund together, in your fourth year of doing it. What was the trigger? What was the trigger early in life that got you going? And then I want to know more about, if I'm not mistaken, you were at a high frequency trading firm and then that went to trend following, but go to earlier in life first.
Had a job as a caddy when I was 13, and I'm a larger guy, and I was able to start carrying 2 bags at a time, and I was coming home with several $100s in cash on a daily basis. And, well, the deal that my father made me was he would stuff half of it in a brokerage account, and I could spend the other half on gas-powered remote control cars. And so the half that I stuffed in a broker account, then I kind of started, well, what can I do with this, but just buying stocks blindly, no strategy is kind of boring, kind of isn't really, well, I was working in the early 2000s. And so I kind of started researching, what worked. And I found that sustainable price moves tended to happen, once something started moving one direction. And so I came up with some simple strategies like buying highs. I was never short selling back then, didn't have that kind of account, but I would try to find stocks that were making new highs and try to capture, I'd cut profits a little short, but it was kind of the premise that finding things that were making new highs and jump on board there. And that had kind of always stuck with me to some regards. So that was early on. And then, went to University of Illinois, where I worked at the library there and continued studying various trading strategies, came across, trend following kind of as a written strategy, and just researched that more and more. And that was always in the back of my mind as something I would like to do. However, the opportunities coming out of school were, in high frequency trading. It's such a big buzzword. And at the time when I started working around 2006, my opportunities that were given to me were in high frequency trading. And I started at the commodities desk at a company here in Chicago called Alston Trading, and fairly soon energy products went electronic, and I was asked to run their oil and natural gas high frequency trading desk, where really what I was doing there was all systematic. So what I was really doing was building risk management algorithms to overlay with passive trading strategies. Passive meaning I was providing liquidity, and in doing so I really built up lots of different risk management algorithms, and decided a few years after that, I really enjoyed doing that, but a few years after that decided I didn't want to be passive. I wanted to be active. And that's where the decision to launch Golden Point Capital came from.
Glenn, who were your influences? Who were the mentors? Was it someone up close and personal, or were you? I've talked to many traders where this has happened too. I mean, for example, Richard Donchian influenced a lot of people, even though they never met him. So who were your influences that got you really going in this trend trading style of thinking?
Some of my influences in that regard, honestly came from some of the literature, some of it being yours that I had read through, and then started to study a big one, being Salem Abraham, working out in Texas. I'm actually have lived in West Texas, seeing his lifestyle and the things that he's accomplished. I really researched there and have kind of tried to dictate a lot what we do after there. And there are certainly others, reading the whole turtle trading system and seeing what they do and trying to reduce the volatility that they experienced, but learning about the faith and discipline that it takes to do it has just been a big influence on me. So there's really not very many specific people. It's really a collective group of all of these people.
What was it about? I'm heavily influenced by what I've seen up close and personal with Salem Abraham, but what was it about him? I don't know. Have you had a chance to meet him, or are you just from afar looking at him and admiring?
Just from afar.
What was it about him that really stirred you?
Well, it was his discipline early on. He had a plan, and it didn't necessarily work phenomenally right away, but he stuck with it and went from there. I mean, I'm talking going back to like his very early days, and I kind of see a parallel with where I've started along those lines.
Listen, you mentioned the name of your firm, and I think there's a little bit of a backstory there, Golden Point. Now, I recently had a chess grandmaster on. I have not played chess since I was a kid. And so would you not have it, that I'm having someone else who is a very smart games player, and I've not played backgammon since I was a kid. Why don't you go ahead and lay out the thinking with backgammon and how you see the parallels to trading?
And you're in Asia, and you'd think backgammon's fairly popular over there.
They play something on the street, but I haven't looked closely at it. It doesn't look like backgammon. Maybe it is, or it's just different colored pieces. But there is some type of game that looks similar.
Yeah. All right. So backgammon's always been an interest of mine. Coming back from my mother played throughout college, and so passed on to me. And the game of backgammon is one of the few games where no matter what, the computer will always win in the long run. There is a proper move to make at every single point in the game. Unlike chess, where the grandmaster can beat the computer, will beat the computer, because it's a thinking game. Backgammon is 100%.
Oh, I got to interject. They can't beat them now. The chess guys are on the other side now. Kasparov. Kasparov lost. So.
Yeah. Okay. Yeah. No, I missed that. But okay. Well, backgammon is, no matter what, the computer is always correct. There is always a correct move to make. Going along with that, I believe that in systematizing a trading system, when you can get it to the point where there is only one correct move to make for every decision to be made, and you have that computer making that decision, then you are really playing the backgammon or playing the trading strategy with 100% proper positioning. And along those lines, in backgammon, you take a lot of small risks early on. And the reason you take these small risks is to capture potentially large rewards, which goes very synonymously with take small risks to potentially make larger rewards throughout trading. And hopefully those larger rewards will offset the smaller risks that you've taken from the beginning.
Have you found the game itself useful for talking to investors? And I assume that's why it's important to you, is that you are using it as a tool to get people to come into your world. Because sometimes, even though to you, to me, and to many practitioners out there, trend following seems, once you kind of get it, it's pretty clear and straightforward, but for a lot of people, it's not. So have you found backgammon a useful and to get people to come into your world?
Yeah, it's been one that people certainly find interesting, and it's certainly something that people remember. And it's something, if someone does have, they can, some kind of experience in backgammon, they can think, oh, okay, I remember, if certain roles there or certain moves dictated. Well, and I kind of tried to relate the whole strategy back to that philosophically.
I think one of the things I've seen in your writings that I really like, though, is the idea that the ratio of the winning trades is not important. It's just the size of the winning trade. Why don't you talk about that? Because that is something where so many people get caught up, even whether they're a pro investor or a retail investor, they just want to fixate on that winning percentage. And you're saying, hold on, what's important is the size of your winners.
Yes, and that's one of the reasons that a lot of people can't stick to a system such as this, is their ego can't accept the fact that they're going to be wrong a lot more than they're right. Well, if we can accept that our trades are overwhelmingly going to be losers, then we can somewhat set our expectations lower on each trade. Sure, it'd be great if every trade could turn into a winner right away, but if we don't expect that, then it's easier to stick with the plan and not let anything distract you from that plan along the way. And it's when you get distracted or when you try to alter the plan that things can start to turn around, and they can turn around quickly. You've seen in our performance history how quickly things really can turn around, and the magnitude that they can turn around when you let winners turn into large winners and losers turn into small losers.
This notion of winning percentage, we can think about it actually in other worlds. And I can think of two that people probably don't normally want to connect to trend following, which would be venture capital and the way Hollywood finances movies. I mean, Hollywood knows they don't expect every film to be a home run. They don't know which ones are going to be a home run. I mean, maybe these days with the superhero movies, they know a little bit more, but still it's a crapshoot. And venture capital, I mean, look, you could be a venture capitalist and Sand Hill Road and have 20 companies in your portfolio, and you really don't know which is going to be the next Google or if they're all going to bomb. And that gets to the whole idea of risk management. But the notion, I think there's this thinking and trend following, you can see it across other worlds. And I like the idea of you connecting the backgammon and just getting people to think and bringing in these other things like film funding and venture capital, getting people to see that what you do is not terribly unusual. It's only unusual that people don't know about it.
Yeah, I agree. Your analogy there is spot on. The whole premise of a lot of these, early stage private equity funds and venture capital pools and whatnot is, sure, they'll throw, another analogy to a dartboard. They'll throw 10 darts and hopefully one of those darts gets somewhat close to the bullseye, and hopefully that one bullseye can pay for the 9 darts that missed the dartboard.
I think on a basic human level, it's counterintuitive because somewhere along the line, we all grew up with this idea that we have to be right about everything.
Yeah, and the problem is when you feel that way is when you tend to stick with something for too long. Well, if you were convinced earlier on this year that oil was going to $160 a barrel. Well, look at we touched 40 at one point, and it's when you're right. It's human nature that causes you to want to be right, and to generally stick with a losing type bet like that. And if you need to be able to avoid that kind of mentality to be successful in this kind of trading world.
Talk about your risk management maxims. Talk about 30% and what it means to you.
We definitely believe that we are a risk management firm more so than we are a trading firm. Something interesting about us in particular is, we have done plenty of hours of testing, and we found that if we just employ our risk management algorithm really with somewhat any kind of simple entry patterns, we've done well. And it's based on that risk management profile. We've actually been able to reverse our signals and still do well as long as we don't overtrade. The 30% to us is a big number where we kind of target that kind of annual volatility. We look for 30%, and that's the kind of the very, very max. Like if something really, really Six Sigma kind of event happened in a day, we would not want to, we want to be set so we can't possibly lose more than that, say, in one day. Now, obviously, the odds of this are small, but they are there. Although improbable, it is possible. So we have things set in place where 30% can happen as the maximum we can lose in one day, given our risk metrics.
What was the thinking behind a trend following strategy that, if we look back in time and we look at the early performance, heck, not even necessarily early for Bill Dunn. Bill Dunn has hit big numbers his whole career. But if I look back at the late 70s, early 80s, I look at the Turtles' early performance, you see the type of returns that you have been achieving so far in your early career. So what was your thinking? Clearly, you just didn't stumble into this. You didn't just stumble into 100% return. You knew damn well that there was the possibility that could happen. But that's also an interesting thing in the sense that you also know in this day and age, every one of these institutional investors, and look, we could have a long conversation about institutional investors, and if any of them are listening to this, it's not Glenn saying something negative about you, it's me. But so what's your thinking though on why you made the decision to be a firm that could go for the 100% plus returns, and what's your thinking in terms of the types of people that you want to appeal to?
My truth thinking here is that I want to be one of those funds that is a single strategy fund. I am not an asset management firm. I am not an end all solve all park all your money here type of firm, and nor do I ever intend to be that. What I offer is one strategy, and one strategy that I will execute fullest to the best of my, I will follow the plan. the asset allocator on the other end can see that, and I'm transparent enough, they can see what we're doing, and it is their job to diversify against it. They can put money in my strategy, and then they know fully well, or they know pretty well what's going on there. That is their job to pool assets to be able to hedge against that. So rather than me trying to be a trend program, a counter trend program, a medium, a short, and a long-term program, I am just trying to do one thing and do that one thing well. I want to leave the rest in the allocator's expertise. That is their job. That is their specific expertise, is to create a diversified hedged portfolio. And I believe that I fit a small portion of that diversified hedged portfolio.
This might sound crazy to the audience, though, but believe it or not, there's many people out there that after seeing you produce 100% in a year will think that there's something wrong with you, or there's something wrong with your firm, or that it's a negative. Even though it's all part of a system, part of a plan, they can look at the prior 2 years, they can see that not everything is always going to be 100% a year. They still would view that 100%. Many people would, and say, there's something wrong here. It's crazy. I know it's crazy, but you know this, though.
Yes. I mean, we've been people, the term cowboy has been thrown around. Or I've also heard, well, you did it because energy moved this year. I don't think you can possibly repeat that again. Well, all I can say to that is, I believe we can repeat that. I don't know when, but I think it's been proven. Markets do trend, and as long as they continue to do so, we will be poised to capture some of these larger long-term price movements.
Okay, man. Talk about. I guess where I'm really looking for you to go is that I talked about some of the early traders in the 70s and 80s that were shooting for clearly your types of returns. You've made the decision that you want the possibility to shoot for that big return. You have not consciously dialed things back, right?
Correct. Yeah, we keep our risk levels, our risk per trades are on the higher end of the spectrum. And yes, we are certainly targeting those high returns. I want to compound. I have, my net worth put in this, and my full faith is there. And I want to compound at a high compound average growth rate. That is the goal. And I believe that this is the approach to doing just that over time. Every year, as demonstrated with our record, is not going to be a fantastic year, but if we can throw in those great years in the mix, then I should be able to accomplish that goal.
You mentioned something about having one strategy and sticking with it. And I think one of the buzz terms that you'll see in traders, in fund managers, is you'll see the term style drift. For the audience out there that's not heard the term style drift, look, plenty of my people in my audience clearly know what it means. So why don't you talk about style drift from your perspective? I actually think that there's some trend following traders out there that hold themselves as trend following traders. And I actually can think of one person who I will not name, sometime in the last decade, who held himself out as a trend following trader, and at some inopportune time decided he was going to become a day trader. So it's not unusual necessarily for some people in the money management world to kind of jump around, is it?
No, it's certainly not. Kind of, style drift is really where I sell that I'm doing one thing. And if I decide to, if I'm a higher risk profile firm, which I am, if I decide to cut that to a quarter of the risk profile without kind of notifying people or anything along those lines, then I'm no longer doing what I was designed to do in that portfolio. And these people, if they're creating responsible portfolios, they have an idea, an allocation based on the profile that I've advertised, that I've told them about. And if I just up and decide to totally change that, then they might have an extra layer of exposure in their portfolio. So it's really irresponsible on my part to do that. And the style drift is really, I believe it's a factor of people, if they do have 2 down years, maybe this isn't working. I'm gonna try something else. Well, as we know, that's generally when things start to turn around, right? when
Yeah.
it gets to the point where people start to make changes. Or, I mean, we saw in 2000, was it last year, 2 years ago, trend following was dead again, right?
Yeah, the obituaries are everywhere, huh?
Yeah, exactly. And that to me was, obviously the signal that, okay, well, it's time to really see this roar. And sure enough, that's what happened time and time again.
One last thing I want to ask, Glenn, and I think it's kind of a good educational reminder type question. I know you talk about it in your daily life to probably to yourself and to clients, et cetera. But talk about the source of profits and the hedging specifically where you see the brunt of your potential profits coming from. What types of hedging do you see your strategy as designed to benefit from the most?
You're talking about hedging on the other end of the spectrum?
Yeah,
hedging
absolutely.
That's creating
absolutely. Other people that are hedging, and so it's a zero-sum game. So when you win, you're capturing their hedging activity. So what types of hedgers do you see is one of the biggest benefits when markets start to trend for you?
When one of the big ones has been, like I was talking about earlier about niche markets, is these producers, if they have supply, they have demand, that their business is not in speculating on the price. They want to keep their profit margin solid year round. And so as things start to move, they have to hedge because they're not in the business of seeing these price moves. And generally I find it to be producers that need to hedge in these smaller niche markets, and especially along the lines of more agricultural type markets. There's certainly lots of needs for hedging in some of the more liquid grains such as wheat, corn, soybeans, etc. There's also demand for foreign currency hedging, as there are so many multinational corporations now that their business is not speculating on the price of currency. And as those hedges come in, those hedges are, large orders. Those large orders, and we're all in the same direction, tend to move things. And these hedgers don't care about price necessarily. They care about their business risk, which if their business is selling cars, their business is not converting yen and US dollars, for instance. And so these different hedge mechanisms are moving markets. But to me, the quickest opportunities, I guess I should say, are in agricultural type hedging and in some of the more illiquid or lesser viewed niche commodity markets.
Yeah, I still it's a fascinating world, and when one wants to look, you clearly know what's going on, but when one wants to open their eyes and look at the source of profits for a strategy like trend following, a strategy that often gets interesting, I'll call it interesting ignorance in press reports, but it's not really difficult to figure out if one just wants to pay a little attention. But I think we open up a much larger conversation as to why major mainstream financial media has no interest in accurately talking about trend following. It might have something to do with the fact that trend following is not really part of their business model.
Right. Yeah, I agree with you there.
Yeah. Hey, Glenn, where's the best place we can send people?
Best place for that is we do have a website, goldenpointcap.com.
I'll add to that too. There's a very nice write-up and article that you had in Futures Magazine in the not recently. So it's a very good write-up, worth reading for the audience out there.
I appreciate it, Mike. Thanks for taking the time.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.